Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Literature Limited Annual Report. China Literature Limited offers a diverse range of businesses and services through its online literature platform. At the core of its operations are online text publishing, online advertising, and game publishing under brands such as QQ Reading, Kidian, New Classics Media, and Tencent Animation and Comics. The company also engages in film and television production, licensing, and distribution, including web and animated series. In addition to these services, China Literature Limited provides copyright commercialization, writer cultivation, and brokerage services. It operates an open platform for text work reading through technology methods and digital media, including personal computers, internet, and mobile networks. The company also distributes online audiobooks and comic content via Tencent and third-party platforms. Furthermore, China Literature Limited offers sales of adaptation rights and scripts, as well as distribution of short-form dramas. It also engages in the sale of physical books and intellectual property merchandise products through its in-house online games operations. Overall, the company's services cater to a wide range of customers, from readers to producers and distributors of literary content. China Literature Limited maintains a market capitalization of 31 billion, broadly in line with the industry peer group. China Literature Limited trades at a higher price-to-earnings ratio of 202 times and a higher price-to-book ratio of 1.41 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 20% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. Interest expenses are consuming a significant portion of operating income, indicating some financial strain. However, special charges appear non-recurring, suggesting that earnings pressure may be temporary rather than structural. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the success of animated dramas has exceeded Rm 100 million in revenue in the second half of 2025, indicating a significant increase in revenue from this segment. Additionally, the IP merchandise business has grown by more than double to Rm 0.1 billion, setting a new record for the company. The premium online reading content ecosystem has also played a crucial role in driving revenue growth, attracting 400,000 new writers and generating over 800,000 new novels. The company's premium content strategy, with frequent breakout hits, has been successful, as well as its diversified, high-quality premium content matrix. Strategic investments in the short drama segment and animated drama initiatives have also contributed to revenue growth. Furthermore, the company's product offerings have improved design capabilities and supply chain efficiency, while its channel expansion through self-operated e-commerce matrices and partnerships with channel partners has increased revenue. The global expansion through AI translation has resulted in a 39% year-over-year increase in revenue. Additionally, the IP plus AI ecosystem has amplified content value and driven sustainable growth. On the other hand, the primary drivers of revenue decline include a decrease in advertising revenues on Tencent channels, scheduling delays leading to fewer releases of drama series and film projects, and a decrease in average MPUs on cell phone platform products and channels. The online business has also declined by 9.3%, while intellectual property operations and others have decreased by 18.3%. The net income of the company experienced a significant decline, with a decrease of 13.4% and a reduction in net income by RMB 111,119. This downward trend continued, with further decreases of RMB 209,216 and RMB 708,964,000 in subsequent years. The profit margins also underwent changes, with the gross margin decreasing from 48.3% to 46.1%. The operating margin and net margin also saw a decline, dropping from -4.1% to -10.9% and from -2.6% to -10.5%, respectively. The decrease in profit margins can be attributed to various factors, including the performance of different business segments. While the online business segment experienced an increase in gross margin, rising from 54.6% to 57.4%, other segments such as intellectual property saw a decline. The net income and profit margins changes suggest that the company faced significant challenges in maintaining its financial stability, with a substantial decrease in net income and a decline in all three types of profit margins. The company's debt level and interest expenses have undergone significant changes. On one hand, the total debt has decreased by a substantial 26.3% from RMB 2,308,000 to RMB 1,709,000. This reduction in debt is a positive development for the company. However, on the other hand, the interest expenses on borrowings have increased significantly from 0 RMB in 2024 to 134,000 RMB in 2025. This increase in interest expenses may offset some of the benefits gained from reducing the total debt. Additionally, the interest expenses on lease liabilities also decreased, but by a relatively smaller amount, from 8,611,000 RMB in 2024 to 7,034,000 RMB in 2025. Overall, while the company has managed to reduce its total debt, it is facing increased interest expenses on borrowings. This mixed trend suggests that the company's financial situation remains complex and requires careful management. The performance of various segments and regions within the company has been mixed. The PRC segment, which primarily operates business and earns substantial revenues, is a significant contributor to the company's overall performance. In terms of performing well, the intellectual property segment stands out. Revenue from this segment increased by RMB 16,446 in 2025 compared to 2024, while gross margin also saw an improvement from 51% to 51.3%. This indicates a stable and growing revenue stream for the company. On the other hand, the online operations segment has performed poorly. Revenue decreased by RMB 771,351 in 2025 compared to 2024, with a corresponding decline in gross margin from 45.6% to 39.8%. This suggests that the online operations are struggling to maintain their revenue and profitability levels. Management is optimistic about the company's outlook, citing a strong leadership position in animation, with 9 out of 10 top titles adapted from their intellectual properties. This dominant market share positions them well to expand into new genres and build a diversified content matrix. To achieve this growth, management plans to fund capital expenditures and long-term investments using cash flow from operations. They also intend to continue investing in or acquiring businesses that complement their main business, further diversifying their portfolio. While acknowledging the risks and uncertainties associated with these forward-looking strategies, management remains committed to realizing their growth plans. This commitment is a testament to their confidence in the company's ability to navigate challenges and capitalize on emerging opportunities. Concerns about inventory buildup and supply chain disruption are growing. The data suggests that companies are holding onto more stock than before, which is resulting in a significant increase in costs. Specifically, the cost of inventories rose by 30.7% from 2024 to 2025, indicating a substantial burden on businesses. Furthermore, there is evidence of inventory buildup across various stages of the supply chain. For instance, raw materials inventory increased by 35%, suggesting that companies are stockpiling more inputs than necessary. Additionally, inventories held with distributors on consignment have risen by 55%. This accumulation of stock can lead to inefficiencies and wasted resources. The combination of these factors raises concerns about potential supply chain disruptions in the future. If companies continue to hold onto excess inventory, it may become difficult for them to adapt quickly to changes in demand or unexpected disruptions. As a result, businesses must reassess their inventory management strategies to mitigate these risks and ensure a more agile and responsive supply chain. That concludes the financial summary for China Literature Limited. Feel free to comment below, and I will be happy to answer them when possible.